Friday, September 18th, 2020, Maneco 64, home of alternative economics and contrarian views. So the Bank of England has hinted strongly yesterday at the fact that they're going to be bringing in negative interest rates. It's only a matter of time. It could happen before the end of the year. It will most probably happen early next year as the economic collapse of Britain continues. Yes, the data doesn't look as bad, but with the furlough scheme ending at the end of October and a lot of other schemes unwinding, unless the government comes out and supports those schemes again, there will be an implosion economically. We will see a real hangover. I think people right now are kind of living in cloud cuckoo land because they're still getting paid not to go to work. A lot of people, they're still getting a lot of support. And yes, there's a chance that the government could stimulate even more, borrow even more hundreds of billions to keep people from working and keep paying them. But that's a farce, of course, because this was supposed to be just an emergency until the economy could go back to normal. But it doesn't even look like the government wants to put the economy back to normal. I saw yesterday they locked down a huge part of the northeast of England, and you can bet they're probably looking to do the same to the rest of the country soon. And I think the Bank of England knows what's coming. So before we look at the markets this morning, let's look at this scenario where the Bank of England will bring in negative rates. There's a story in the Telegraph from yesterday. It says Bank of England moves a step closer to negative rates. So we'll go through that story. It's a pretty good article. It says Monetary Policy Committee minutes reveal rate setters have been briefed on plans to implement a negative rate if warranted at some point. So yeah, they had their meeting yesterday. They did not do anything in terms of cutting rates, which is at 0.1 anyway. And they did not increase the QE, but I think they will very soon do so. So this is what the article says. The Bank of England took another step towards controversial negative rates on Thursday amid rising COVID infections and the looming unemployment crisis. I'm not going to go over this crisis, but one thing I would say, they locked the country down because they wanted to bring the curve down, flatten the curve. Now it's all about this testing and infections, right? Even though coronavirus is not killing anyone. So as I said before, this is an engineered crisis. This is an engineered takedown of the economy. And why are they doing that, you might ask? Well, because there is no other way out. We've got so much debt that we need to flush it down the toilet, so to speak. I know it doesn't sound very nice. And at the same time, keep a semblance that things are going. And that's why they're keeping the system going for now, increasing the debt. It's their last chance. But there's no way this economy is going to get out of this because all this debt that the government is incurring, the negative rates that are coming, is going to hurt the private sector in a big way. And it's going to hurt savers. And savers are the backbone of a free market capitalist economy. They provide the seed, the seed for growth, right? But if you destroy that seed with negative interest rates or zero rates, there will be no growth. And especially if you put in a bad seed of government, if you plant the bad seed of government, because government does not create wealth, right? So let's keep going. The bank's Monetary Policy Committee, MPC, unanimously voted to hold interest rates at their record low of 0.1% and kept the scale of its money printing program unchanged at $745 billion. That's the QE. However, minutes of the meeting said the MPC had been briefed on the bank's plan to to explore how a negative bank rate could be implemented effectively should the outlook for inflation and output warrant it at some point. The Bank of England and the Prudential Regulation Authority will begin structured engagements on the operational considerations on the move in the final quarter, the minutes said. So they're going to start looking into it very soon. Major central banks, including the Bank of Japan, the Swiss National Bank, and the European Central Bank, have already taken rates below zero, although retail depositors have been shielded. But they're getting nothing in those countries. And is it improving their economies, the negative rates in Japan, Switzerland, and the EU? I don't think so. We should be doing the opposite, of course, but central bankers, they've become, how can I say, deluded. They don't realize that sometimes you need to let things go the other way. You need to let interest rates increase. But they're not going to do that, of course. They still think they can save the system, but I think it won't be saved. The bank has been reviewing its ammunition to tackle the coronavirus crisis since the summer. Governor Andrew Bailey said last month that negative rates were in the policy toolbox if needed, although the bank did not expect to use them. The other thing I would say, UK banks are in such bad shape that negative rates would not go a long way to helping them. It would cut their margins as well, right? The bank has also expressed concerns over the potential counterproductive impact on credit provision if lenders' profits were damaged. The more advanced preparations for a potential move below zero sent the pound lower in the aftermath of the policy decision before regaining ground. There you go. The pound dropped yesterday, 0.7%. Is it important to look at the pound versus the dollar, how it's doing? I saw an article yesterday saying the pound has rebounded really well this year, but versus real money, gold and silver, the pound, the pound's down 30% versus gold this year. So you won't see that in the mainstream press, of course, and that's why you need to stay in the precious metals. That's my opinion. I'm not giving up on precious metals. This is the most important time to have precious metals. The last few years have been good in terms of the fact that precious metals have gained ground versus fiat currencies. But now the insurance policy of precious metals is going to really kick in my opinion. Let's continue because this article talks about how the Bank of England is also looking for a big slowdown in the economy, which I've been telling my viewers for months that was going to happen once they withdrew all the schemes. Financial markets already pricing a move into negative territory by the MPC as economic prospects darken, are forecasting a cut to minus 0.1% by mid-2021. JP Morgan economist Alan Monks said the BOE is serious about negative rates. The more it talks about this option, the more it looks as if it has all but made up its mind. Despite a slightly faster recovery from April's nadir than the bank expected, the UK economy is still 11.7% below pre-COVID levels, and Threadneedle Street is warily eyeing a rising infection rate. There you go, that infection again. The bank said, and I quote, "The recent increases in COVID-19 cases in some parts of the world, including the UK, have the potential to weigh further on the economic activity, albeit probably on a lesser scale than seen earlier in the year. There remains a risk of a more persistent period of elevated unemployment than in the central projection. Threadneedle Street has forecast unemployment peaking at 7.5% in the wake of the crisis, which would mean a rise of more than 1 million in the jobless totals." So there you go. Right now, it's not looking bad because a lot of the people are on furlough, so they're not being counted as unemployed. So there you go. There's no end in sight. to the madness of these central bankers and their policies, and to the madness of the governments as well, who think you need government to fix everything, right? And the central bankers are going right along with the governments, of course. There is no central bank independence. They've become basically an arm of the government and economic, fiscal, monetary policy. They're working all together. So that's another nail in the coffin of the British pound, of all fiat currencies, actually, because this is happening everywhere around the world, of course. But being in the UK and seeing that a lot of my viewers are in the UK, I'm covering this, of course, but you can extrapolate this to other parts of the world. So let's finish off with a look at where the markets are. I'm a little later today. It's 9:20 a.m. London time. Yesterday, the stock markets, of course, had a rough start in the pre-market, in the futures. They did recover yesterday, but they still finished lower, especially the NASDAQ finished down over 1%. S&P finished down almost 1%. And the other point I would make as well, before quickly going through the markets, is that year to date, the NASDAQ composite is up 21.6%. But gold, on the other hand, is up 28%. So gold is starting to outperform even the NASDAQ now. A few weeks ago, or even a week ago, we were seeing both indicators match each other in terms of gains for the year. Silver is doing even better. Silver's up about 50% on the year. And I'm taking the last fixing from 2019 as a reference. I think gold fixed on the 31st of December on the LBMA at 1523. Right now we're around 1953 in gold. Silver fixed around $18, and right now we're at 27. So that's how I got my numbers here. Well, the Dow and the S&P, I mean, we're talking huge outperformance by the precious metals. The Dow still down 2.2% year to date. S&P's up on the year, but only 3.9%. So right now we've got gold at 1950, 360, up just under $10. Range has been 1956 to 1941. Silver is at 27.13, up 13 cents, so up 0.5% like gold. So we want to see silver actually outperform gold. It's encouraging that it's back up, but we want to see it push a little more. The Dow futures unchanged. S&P is up about 5 points. NASDAQ composite is up about 0.4%. The currencies, sterling is unchanged. The euro is unchanged as well. So not much going on here this morning in terms of the currencies versus the dollar. The price of oil is quite strong. WTI crude is up about 0.25%. But it's gone through 41. I think yesterday we're just below 40 when I did my video. So we're at 41.30. So you've got commodities now starting to go up. And we've got the central bankers, of course, saying that there is no inflation, even though we know that inflation is not really their phony measures of prices, but inflation is the excess creation of money and credit, not backed by anything, right? It's the creation of fiat currency out of thin air, not backed by real savings, so to speak. The 10-year yield, we're seeing actually the 10-year yield rise slightly. We're at 0.68. Yesterday we were at 0.67. Very small rise in the 10-year yield. So I would have expected maybe yields to drop a little bit yesterday with the weakness in the stock market. But it wasn't a huge drop in the stock market, so yields are still pretty steady. Just to give you an idea of UK yields, UK yields are negative all the way up to the 7-year. That's the gilts, the UK government bond. The 7-year yield is at minus 0.006. Yeah, it's a tiny amount, but it's negative. That's significant. The 2-year yield, for example, is at minus 0.1. So that means that the market is forecasting a negative short-term rate going forward. So that's what that means. The 10-year yield in the UK is at 0.19. So there is no safety for investors in the UK. If they want some yield for their savings, they're going to have to find some very risky bonds. The government is not paying anything. If anything, you're paying the government to lend to them. With the economic situation as it is, do you really want to lend to anyone at such low rates? Or do you really want to lend to really dodgy or risky businesses at a higher rate? I don't think so. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.